Hello, everyone. Welcome into Above My Pay Grade. Gen Z and millennials, they are in the hurt locker when it comes to debt. Big time, more so than any other generation, because they've been saddled with student loan debt, car debt very early on in life. Not to mention the coronavirus, they were able to buy a car way beyond their means to use the stimmy checks as collateral or uh, forms of income, kind of like 2008, the housing crash, where people didn't really check and they were able to buy a new car and not pay on it for a while because of the pandemic. And now the chickens are coming home to roost and defaults are going way up. Let's take a look at this article here. Now more than ever, young adults are defaulting on auto loans in an alarming rate. These are trends that are constantly going up when it comes to student loan debt and car debt. And from a macro perspective, this ain't good. This ain't good because if you have a society that is not credit worthy, how do you have economic stability at all in that country if the society as a whole is all in massive amounts of debt and a credit score is hot garbage? According to a recent NBC News article, TransUnion data comparing pandemic and current default rates of Gen Z and millennial car owners showed a startling difference in those generations compared to others. In 2019, before the pandemic began, Gen Z had past due rates of 1.75. Today, the past due rate has reached as high as 2.21. Now, you might say that's not that high, but look at the rate of change. That's very massive when it comes to defaults. Among Gen Z car owners, 2.21 among Gen Z car owners. Similarly, millennials now show an increased past due rate of 2.14 compared to 1.66 before the pandemic. Now, you got to ask yourself, why is this? Why are people defaulting on their cars more than ever? You all remember 2021 when used cars were insane, insane. Only time in history that you could buy a car in 2019 and sell for more in 2021. Myself, I bought a vehicle in 2020 and sold it in 2021 to the same dealership that I bought it from for 7,000 more. So I bought it in 2020. I sold it back to the same dealership in 2021 for 7,000 more than I bought it for in 2020. That is crazy. That is absolutely insane. And so then somebody came to the dealership and bought it for 7,000 more than I bought it for, if not more, a year prior. So the loan to value was nuts. So obviously, if you don't pay on your car loan, uh, people just think it goes away or they'll get out of it. Obviously, you can bankrupt. You can go bankrupt. You cannot default on your student loans, but you can default on your car loan. But it definitely affects your credit, sets you back about 7 years. Your credit score will be negatively affected. Your car may be repossessed. And repossession, I've been looking at the data and watching some YouTube videos on this. Repo lots, guys who do repossessions are buying acres of land because they know it's coming. Because people went because the money was flowing, people were buying cars with their PPP loans. All I got to do is Google that. People buying Lamborghinis with their PPP loans. People using stimulus as forms of income to be able to afford the car, then not paying on it for 2 years. And all of a sudden the payment comes due after the pandemic. And wait a second, I thought this was just a free car. No. Okay. You could still owe money after the cars are even repossessed. And the remaining debt could be sent to collections. Those people are great dealing with people from collections. So according to Cox Automotive, the average cost of a new car reached $47,000. So Gen Z and millennials, I say they're in the hurt locker because everything's more expensive adjusted for inflation. Housing, healthcare, college, cars, everything. And their wages haven't gone up commensurate with inflation. So that $47,000 in May of 2022, this is 13.5% increase from the average cost only 1 year ago in May of 2021. Record-breaking new vehicle prices are making car purchases an even bigger challenge, now requiring 40.6 weeks of income on average, close to 1 year's worth of pay to buy a freaking car. You see how this is like a domino effect? Like if everything's getting more expensive and your wages aren't going up, something's got to give. And these people are choosing their credit score. But in my opinion, you should choose your quality of life because you have to make this either the decision's made for you or you make the decision prior. Meaning, hey, maybe I can't afford a car. Maybe I have to get that rust bucket jalopy instead of a brand new car because if I buy this and I can't afford it, my credit's going to be tanked for years. These financial challenges may contribute to the increase in auto loan default rates of Gen Z and millennial car owners in particular. You don't say. According to TransUnion data, 4.35% of car owners aged 18 to 40 were at least 60 days late on their auto loan in early 2022. As mentioned above, the data also shows that the current default rates for Gen Z borrowers are 0.46 higher than they were pre-pandemic, which rates for millennial borrowers show an even larger increase of 0.48. So they're going up, and the rate of change is pretty astronomical. In addition to Gen Z and millennials, in addition to Gen Z and millennials is experiencing higher rates of inflation, they're dealing with negative financial aspects due to lower average credit scores. The average U.S. credit score required to purchase a new car was 726 in 2021. This is mind blowing. Gen Z has an average credit score of 660.5, and the average credit score for millennials is 667.4. So if you go to a dealership with that kind of credit score, what do you think your interest rate's going to be? And if you drive it off the lot, it lowers in price. So not only are these, even if you're making the payment, you're upside down on the car, meaning you owe more than it's worth. So if you ever want to sell it, you sell it, and now you owe money with no car. Massive problems. And these people were buying cars that were way overvalued in 2021. Another challenge that likely contributes to the higher default rates is increasing amount of time it takes to pay off an auto loan. As per usual, we're not going to lower the price. And this is one of my concerns about homes too. If homes keep going up in price, you know what the federal government's going to do? They're going to make the loan, they're going to extend the duration of the loan to lower the monthly payment, which guess what that'll do? Increase the price. Okay. But so, car payments, you can now pay for 84 months. In 2021, 27% of auto loan borrowers were taking out 73 to 84 months to pay off their loan, an almost 7% rise from the previous year. So that should be an indicator to you. Hey, these people are extending their loan out for longer and longer durations, meaning they can't actually afford this car. And the car dealership doesn't care. Get it off the lot. But everyone's making money, but the person buying the car, obviously. With longer loan term, borrowers will likely pay a higher interest rate and ultimately end up paying more over time. Stacked with higher interest rates from having lower credit scores on average, this can increase the likelihood of loan default. So basically, you're paying a year's worth of income to get to work. This doesn't end well. In the aggregate, if we're looking at trends, and I'm going to dive deeper into this auto loan story as it progresses, but if the incentive is like people were able to go and buy a car that they couldn't afford in ways that have never existed in 2020 and in 2021. And how were they able to do this? They were able to do this because they used stimulus as income. So the banks weren't doing their real due diligence. Sounds like 2005, 2006, 2007 when it comes to homes, right? So they weren't doing their real due diligence, and they overpaid on the car, and they did an 84-month payment, and that 84-month payment they haven't even started paying on it because they were able to delay. So they went to a car dealership, bought a car, then went to their bank and said, "Sorry, can't pay on it because of coronavirus." and it was legal. So, and it didn't hurt their credit when they weren't paying. And now those payments are coming due, and they have this car that's way overvalued. They paid $30,000 and it was worth 20, or they paid $50,000 and it was worth 30. And these people are going to start defaulting at epic rates, in my humble opinion. Why? Because they're going to start losing their job in 2023. Even if they don't lose their job, inflation's going to crush them. So they're going to have to decide what to cut. They can't bankrupt on their student loans. What else can they cut? They can live on their friend's couch and cut their car payment. That's what they're going to do. Let me know what you guys think in the comments below. See you guys in the next one. Peace.